Hey everyone, welcome to today's show on Wealth Strategy Secrets. Today we are joined by Yonah Weiss. Yonah is a powerhouse with property owners' tax savings. As business director at Madison SPECS, a national cost segregation leader, he has assisted clients in saving hundreds of millions of dollars on taxes through cost segregation. He has a background in teaching and a passion for real estate and helping others. He's a real estate investor and host of the top podcast, Weiss Advice. Yonah, great to see you. Welcome to the show.
Thanks so much, Dave. Great to be here.
Yeah, no, awesome to have you on. I know we've spoken a bit over the past couple of years, but before we jump into some of these exciting topics around tax savings, right, which is what a lot of investors are always trying to maximize. But for folks who, really don't have any familiarity with you, can you start off with telling us a little bit about your background and your journey, how you kind of got into real estate and where you are today?
Sure. So, as you mentioned in the intro, my background is in teaching. I was actually a teacher for many years, about 15 years. And that's really been my passion. I started a nonprofit organization during that time to help kind of underprivileged families, people going through, dire situations like health and, death in the family, those kind of things. And that's really been my passion, helping people and teaching people for my whole life. But about, 7 years ago or so, I, was kind of struck with, well, wait a second, I got a big family. I'm going into lots of debt and, just trying to keep our head above water, making ends meet. And the teacher's salary was not really cutting it at the time. And I was like, let's see what other options are out there. Asked around to a few friends, and real estate kept coming up. And I just explored different options, and as a happenstance or divine providence, whatever you want to call it, I ran into a friend and asked him, hey, I'm looking to get into something. I know you're in real estate. Like, what do you think? He's like, listen, and this is a good friend, David, also Dave, good friend of mine for many years. And I just happened to run into him. He said, listen, he was a commercial mortgage broker. He was a property manager, owned a lot of, properties his family did. And he said, I just, stop working at this company. I'm going to start a new venture. Why don't you come and work alongside me, and I'll teach you everything there is to know about commercial real estate. So I basically apprenticed him for about 8-9 months. And it was amazing. I just sat in his office every day, or at least like 4 days a week, not every day, but it was incredible. At that time, learning about commercial mortgages, about, financing, about everything there was to know. And so that kind of took different iterations, and I learned a lot of different things. I got my residential broker's license just to, find deals, et cetera, and did a few fix and flips together. And, long story short, I was enjoying it, but it wasn't really still, not really making a lot of money, because it takes a lot of time to build up a portfolio, to build up a brand, et cetera. So, and then at one point I came across this company, Madison. Someone introduced me. So we're the company I'm currently working at 5 years now already. And they were, needed a position with this cost segregation division of the company, doing business development. And really what I found was it was more teaching than anything else. And so I was like, hey, I can do that. I can give webinars learn about this subject. And because of my background in teaching, one of my kind of superpowers, if you will, is that I can learn kind of complex things and then be able to teach them.
Yeah, that's really excellent. There's this concept we call unique ability, right? Which is really trying to understand, what your true strengths are, your innate wirings. And then, once you can really hone in on that, it's amazing how powerful that it is, because it really comes natural to you. And that's where you see the most results. But ironically, in school and typical academia, we're taught to kind of be a jack of all trades, and let's try to get smart in all these different areas. But in business, it's not that way.
Yeah, exactly. And, I just kind of found a niche, and it's been working out really well since then, and which has allowed me to explore other opportunities in real estate and other investment opportunities as well.
Wow, that's great. And so in terms of your own, philosophy around investing and kind of building your wealth, do you have a particular investment thesis today, or do you have a strategy in place that you're focused on?
So I never really grew up with, it's an interesting question. At this point, obviously much more sophisticated than I was even when I was a teacher, because as a teacher, I wasn't involved so much in finance, and I didn't have a background in finance or in investing or even anything like that. And as many people who grow up in the regular system, you're just not taught those kind of things in school. But at this point, after having been involved in the industry for many years and having just learned so much from the people that I surround myself with on a daily basis, I have, like I said, started investing. So my thesis, if you will, is really just to find as many cash flowing investments as I can to, and that's a hard thing to come by, but you have to have capital to invest, and that's really the start of it. And partnering and finding the right partners to make new opportunities, create new opportunities. So I'm really open to new opportunities, and things come my way all the time. And so I've invested in many, many different asset classes that have just seemed interesting to me. So that's kind of my thesis is kind of fluid, if you will.
Yeah. Okay. And are those syndications? Or are you doing more active type of investing?
They've mostly been syndications, so a lot of LP limited partner investments in syndications. Although I have taken upon myself to start a fund to start raising capital for other deals and become more on the active side, less active than actually the operations, because that's never been my skill set. But in raising capital and doing things like that, the investor relations is definitely much more up my alley. So that's actually a direction that I'm heading as well.
Oh, that's great. That's great. I didn't realize that. Yeah, I mean, it's interesting, right? Because as you kind of look at, a particular investment thesis and everything, we're trying to identify these asset classes that are really asymmetric, in nature, right? That have low risk, counter-cyclical to the markets, right? You have this cash flow component and then some kind of upside on the back end. But it's interesting as well is that, I think a lot of people just don't really look at it tax from this lens, in the sense that, taxes are actually, the number one wealth destroyer that's out there, right? Bar none. And it's the biggest line item on your income statement,
100%.
and there's a sobering statistic I've heard from a top CPA that says, if you think about it, you could potentially work, 4 to 6 months out of the year for free, really just to pay your taxes, right? So that is really sobering to put your head around, to just think that you're paying that much in taxes and that much of your time.
It's crazy. It really is. That was one of the things that really, when I first read Rich Dad Poor Dad, that statement kind of jumped out at me. Is like, people do, the craziest things for just having a job. And that was one of the things that triggered it for me. And I understood how these taxes work, and especially with related to real estate, and why I'm really so passionate about the cost segregation and about teaching people about this, because most people hear about real estate investing and the tax benefits that come along with it, but never really kind of get past that and don't go too in depth into it to understand, well, what are all of those tax benefits?
Okay, so perfect segue, Yonah. Let's jump into it here. I think we do have a lot of listeners who are, new to investing, new to in real estate and everything. So why don't we just try to break this down for everyone, and, just say, if you were investing in a multifamily property or something, talk to us. What is a cost segregation study? How does it work?
Absolutely. So let's just take a step back a little bit and understanding what understand what a cost segregation is. I think we have to understand what depreciation is, because cost segregation is just an advanced form of depreciation. And unlike the name, depreciation is actually not a negative thing, right? The definition may be, if you look in the dictionary, it means something is going down in value, with the, time going. However, from a tax perspective, the IRS just borrowed this term to give a real estate tax deduction based on that concept that things go down in value. So when you buy a residential, commercial, any type of investment property besides for your personal residence, you're able to take a deduction from your income tax called depreciation. Okay. And it's based on, like I said, based on the concept of things go down in value. However, it's more a borrowed term than anything else because it starts the day that you buy the property, not the day that the property was built. Okay. So if you buy a property that was built in 1975, it starts your new depreciation of 27 and a half years for residential properties or 39 years for commercial properties today. And so that's an amazing thing. When you sell it, the new buyer starts the whole schedule over again, and based on their new purchase price. So it's not intrinsic to the property. That's something really important to understand, but it's probably the most important tax deduction that is out there. Now, what we do with a cost segregation study is the weird name, but essentially what we're doing is breaking down the property from an engineering or construction engineering perspective and showing how different components actually depreciate faster than that 27 and a half or 39-year schedule, meaning you can take a tax write-off of certain components over a faster period of time, over a 5-year or 7 or 15-year period. So essentially that's what we're doing. We're coming into a property and breaking it down into its individual components, creating a very detailed report that shows the value of all those components, like the walls, the doors, windows, carpet, right? Cabinets, countertops, shelving, window treatments, every little tiny detail down to the bolts and screws, and showing what the actual value of all those individual components are based on the purchase price that you paid for it. Right. So it's actually quite complicated calculations because we're not talking about a new construction necessarily where you know exactly what the cost was that everything went into to build it. We're talking about buying an existing property and reverse engineering how all those individual components can add up to that purchase price.
Makes sense. So, I mean, why is the government overall actually giving a tax deduction, right? Why are they giving you a tax deduction on this?
It's a great question. I think there have been a lot of theories around that. I know Tom Wheelwright in Tax-Free Wealth talks about the fact that the government incentivizes certain investments or certain types of businesses that contribute to the economy in different ways. And real estate definitely contributes to the economy. And so giving certain tax deductions allows those investors to take that money and reinvest it. And it's simply that drives so many different factors in the economy as well, besides for just providing housing, providing work and jobs for so many people. So I think that's probably the biggest reason why. However, it may not be the case that the people passing the laws are real estate investors themselves and trying to incentivize themselves, which, I wouldn't be surprised, but that's certainly the case.
Right. Yeah, it's actually a tax incentive because we're partnering with the government, right? And, not only is it helping the economy, but we're providing housing. Right, for people, and that's what the government wants you to do. So if you align with the things that the government wants you to do, you get some incentives in that manner. Let's just jump back a second. I think we skipped over an important piece too. I just want to add a little more clarity to. So we have this concept of depreciation, right, which you explained for commercial and residential, how you can do a cost segregation study to really account for all of these different items.
Right.
But let's talk specifically about bonus depreciation and the rules around that and accelerating that.
Sure. So bonus depreciation was a rule that was introduced or adjusted really from an original law back in the 2017 Tax Cuts and Jobs Act. So it used to be something that was strictly for new construction properties that developers could take a tax deduction of a certain percentage of their cost of the construction. However, what happened in 2017 was just, it was unbelievable what that did to the industry. It introduced a law that's called 100% bonus depreciation. And what that says is once you've done a cost segregation study and allocated these components to faster schedules, like a 5-year or 7 or 15-year schedule, you now have the ability, instead of spreading that out over those respective timelines, to actually take the lump sum of those accelerated deductions in the first year. So 100% of those deductions. So just to illustrate what that means, okay, just take a quick illustration, just make really round and simple numbers. If you buy $1 million property and you were to take straight line depreciation, meaning not doing a cost segregation study, just spreading it out over a 27.5-year period, your depreciation deduction would be approximately $30,000 a year, okay? Simple math. We have to subtract a small amount for land always, so I'm taking that into account. Land does not depreciate, but the rest of the building and all the components do. So if you do a cost segregation study and apply, let's say, 25% of those of the cost of the building to a 5-year, 15-year schedule, instead of taking $30,000 a year, you'd be basically doubling that in the first 5 years. So you're taking about, let's say, $200,000 extra into the first 5 years. And so instead of $30,000 over the first 5 years, it's approximately $60,000 to $70,000. So that's a great tool, right, to have. Create more deductions, reduce your taxable income, create more cash flow. What bonus depreciation says is take that whole $200,000 and take it in the first year as a tax write-off. And so that's literally game changing. If you think about, the ability to reduce your taxable income and not pay taxes, this is the number one contributing factor to that.
Absolutely. And I think this is really interesting because when you look at the cycle of that, right? And coming back to wealth strategy, and as I'm doing, my wealth strategy and kind of talking to investors and everything, there are some investments out there that have longer hold periods, 10 years, maybe more, things like that. But look, if you're doing multifamily syndications, just like you're talking about, every time you acquire and you exit a property, you completely start that clock over again on the whole bonus depreciation, right?
Exactly, which is crazy. And that just creates these deductions, like you said, and it allows people to have an investment that is basically a tax shelter for the life of ownership, the life of an investment.
Right. And let's talk about the other kind of hidden piece, which doesn't get as much attention as well. But, let's talk about when you do exit and the recapture. So how does depreciation recapture work?
Excellent question. This is one of the biggest misconceptions or misguided topics that I see so much misinformation about out there in forums and in discussions, things like that. So I'm glad you brought that up. What recapture tax means is that when you sell a property, you're going to be subject to a tax on the amount of depreciation that was taken. So it does not mean that you have to pay back all the depreciation. First of all, you're never going to have to pay back. It's being subject to a tax. But second of all, as I'll talk about in a second, there are many strategies around ways to actually defer or reduce that recapture tax upon the sale as well. But simply put, when you sell, just like you have a capital gain, which everyone understands, if you make a gain on the sale, you're going to be subject to a tax on that gain. So too, recapture tax is considered an unrealized gain because if you've taken these deductions, it's lowering your tax basis. You're now going to be subject to that tax on the sale. It's actually taxed in 3 different ways, which means there are different levels that it's taxed on. Certain components or certain amounts of that recapture tax is taxed at an ordinary income tax rate. And certain components are taxed at like a capital gains or 25% capped tax rate. And there's an even third component, which is, I'm not going to talk about because it's kind of like a sliding scale, but it is a pretty complicated. However, like I said, deferring that probably is the best strategy that you can have if you can do that through a 1031 exchange or through other methods of deferring that tax, as well as other methods like we talked about before, having other losses from investing year after year into a new property. You may be able to have enough deductions or losses from the cost segregation done on a new property to offset the gain or the losses, the passive gain of that recapture tax upon the sale.
What if everything you thought you knew about investing was wrong? Would you like to create a wealth strategy like the top 1% have and get exclusive access to top private equity deals that provide downside protection, tax efficiency, predictable cash flow, and have a lucrative upside? Discover how with the Pantheon Advantage and join our investor club today at pantheoninvest.com. Right. No, thanks for that. I mean, that is excellent because that topic requires a lot of clarity, and I think you're right. There is a lot of misunderstanding, in the marketplace as to, how recapture works, or in some cases, people aren't even aware of it, and then they're kind of surprised, right, on the back end, and they don't have a strategy in place in terms of how to handle that. Would you say, if you were to tell a real estate investor, I mean, is there some kind of range, like, let's say, just, yeah, again, for round numbers, let's say you had 100,000 in depreciation that you took, and that recapture would be a tax of, is there a range or a percentage that you could just roughly point out?
It's pretty complicated because, again, like I said, each person in their individual case, the actual calculation will be different. But simply put, if let's say you take 20% of your depreciation, let's go back to our example, that $1 million property, right? And you had $200,000, you took the bonus depreciation, you took a $200,000 deduction in that first year, and you go to sell the property a few years later, you're going to be subject to a tax on that $200,000. So a portion of it will be taxed at a 25% rate, and a portion of that will be taxed at your ordinary income tax rate, whatever that is.
Right. Yeah, and this kind of goes also into our overall comprehensive wealth strategy, right? Which is having an actual proactive tax planning strategy, right? That you're constantly looking at the entire picture of all of your different investments in your portfolio, how they kind of work together, what your income is in a certain year, right? So you can manage when sales happen. And it's interesting because some people are afraid of the tax consequences, whether that be selling something from the stock market and trying to reposition assets into, real estate, because they say, well, I've got a, taxable gain over here that I have to pay for. And then if I come into this and there might be some recapture, where am I going to really end up, right? But if you do take the time to have this proactive tax strategy, you can actually mitigate all of that. And technically, the goal is actually to get to zero. If you are an investor, you can get to tax rate of zero, right, by using these strategies.
Right. And I think that's probably one of the most unknown things about the cost segregation is that point that you just mentioned there. If you are reducing your taxable liability, you may actually be reducing your overall tax rate down so low that, and this may sound a little strange to some people, but that may actually provide certain people with other tax credits and other things like that, that even though you're making a lot of money, you're just not legally taxed on that because of all these deductions, and then maybe even eligible for other types of, benefits.
Right, right. And do you do just cost segregation studies for real estate? Have you looked at any other asset classes, or like, oil and gas, or other asset classes?
Not personally, no, not really. I
Yeah,
mean, focused on real estate, many different asset classes within real estate. So I've invested in, self-storage and mobile home parks and RV
yeah.
parks and things like that, besides multifamily and single families. One thing I'm focusing on is actually short-term rentals right now, but like an Airbnb property. But no, oil and gas is not something that I've
Got
looked
it.
into.
Yeah, yeah. It just super interesting tax breaks.
Right.
We've been working on this asset class this year, and you're able to actually offset active income, which is really huge right on the front end. And that gets into, some more complexities around the tax code with depletion and different things, how they offset that as well. But can you tell us, Yonah, is there some type of, parameter people could estimate, right? So if let's say you're building out a model and trying to understand, again, like tax consequences, you might have invested in a syndication. Would a multifamily syndication roughly be maybe 60 to 80% of your investment or something? I mean, is that fair to say that you could, you would have bonus depreciation applied to, or do you have some type of range?
Well, That actually is going to depend on several factors. And so I've seen, and I'm sure you're referring to, we'll see all these investment, offering memorandums and things where people are pitching a certain amount of bonus depreciation will cover your investment and things like that. It actually depends on a few factors. And one of the biggest factors is the amount of equity versus financing in that deal, because the depreciation amount that you can take, the total, property depreciation, is based on the purchase price. Okay. Which means if you buy it all cash, for example, then the proportion of depreciation per your cash or equity investment is very, very low. Okay. However, if you're financing that deal, that increases the amount of dollar per dollar per of your equity investment to your tax deduction. So just to illustrate that, again, let's use our example of $1 million, right? Let's say you bought it all cash and you're taking 25% in the first year bonus depreciation, right? You're getting $200,000 or $250,000. Well, if you paid all cash, you're only getting 25% of your investment back as the bonus depreciation. However, if you bought that same property with a 75% loan to value loan, right, then you're only putting down equity of cash of $250,000. And if you get that $250,000 bonus depreciation, you're going to be getting 100% of your investment returned as a tax deduction in that year. So leverage is a huge factor. And I see a lot of people making a mistake in this and just assuming that every deal is going to be exactly the same, when in fact, you may be trying and having a lower loan to value, maybe actually much more, of value in terms of the return on the investment and things like that. Having lower risk, and maybe investors are raising more equity for capex or for just have extra reserves, and the more equity that's there is actually going to reduce the amount of that ratio of bonus depreciation.
Right. No, that's a great point. What would you say to investors? I mean, we have a lot of investors who they may have had a liquidity event, maybe selling a business or something, or, they had a big year, high commissions or something like that, with their income. Are there any, asset classes or things to look at, if they were trying to really take advantage of, the bonus depreciation and tax, efficiency out of certain asset classes?
So unfortunately, this is a big misconception as well that people don't understand, is that the real estate or rental income that you have is kind of treated differently than any other type of income or other types of gains, right? Real estate gains or capital gains, and again, real estate income are like kind of treated in a separate bucket, a separate category, which means that this depreciation is great and the cost segregation is really a great thing. However, there are limitations, meaning you're only going to be limited to use those deductions against any passive gains or rental income, which the IRS treats as passive income. Unfortunately, if you have a gain from the sale of an active business or stock sales or things like that, those are treated as active. And unfortunately, the depreciation cannot offset that unless you qualify as a full-time real estate professional, which means that either you or your spouse have a full-time job in, renting and brokering, managing, et cetera, real estate. And that being the case, real estate for high W-2 earners, investing in real estate is great because at least the returns that you're getting from that investment are going to be, like we mentioned, a tax shelter and are going to be covered by that depreciation, but you're not going to be able to use those deductions against any other source of income or other, capital events like you mentioned.
Right. Yeah, it's really an entire phase around basically asset repositioning, right? Because, we're all taught from Wall Street that the best thing we could do is buy stocks, bonds, and mutual funds, right? And then we'll have another bucket for, annuities and bonds and everything.
Right.
And that's, that's the safest way to invest. But I think as you start to understand some of the, multidimensional benefits of real estate, some of these other asset classes and everything, and you start to reposition your assets in this way, and then you start building up your passive income, right? And as that passive income starts to grow, it's small on the front end, but before long, you're all of a sudden paying your mortgage, right, with mailbox money that's coming in. You're not having to do anything for it. And oh, by the way, you can completely offset that income with these gains, or the bonus depreciation that you're talking about from here, right?
Right. 100%.
So you're kind of like going through this whole process of trying to really reallocate where your income is coming from, right, over time.
Yeah, that's exactly right. And, it's part of the strategy, like you're talking about, of the wealth building and the, financial literacy experience, which takes time, and you learn as time goes on, and hopefully having the right advisors and the right people guiding you in the right way to do it and grow your wealth in the best way possible.
Yeah, absolutely. And, really, I really applaud, what you're doing, Yonah, because, education in the space and financial education, and it's really, part of our mission as well. It's to really help people figure these things out, right? And provide some facts and some objective data points so they can make intelligent decisions. Because everyone, we just keep getting brainwashed by Wall Street saying this is the only thing you can do with your money, and that's the smartest thing. So it really takes a lot of courage to go against the grain. I mean, I was just talking to an investor last night that's like, well, it all makes sense. We have some investments. It's starting to we're seeing the effects of it. But it's still pretty bold to go to your broker, your fund, or whatever, and go liquidate a bunch of funds, and have that tax consequence and the thing, come together. So,
Right.
getting really good advice is super key. And then, I got to tell you also, I mean, it's amazing every time, tax year comes out, and you see this bonus depreciation like in real time and how it works. You start to see your marginal effective rate, you see your AGI, and then you get down to your marginal effective rate, and then the net amount that you have. And it's like, I mean, it's really, really powerful.
Yeah, exactly. Especially when that net is a negative, right?
Exactly, exactly. And, I mean, frankly, that was the entire controversy. I mean, not this is not a political statement by any stretch, but, why they were tracking down Trump and saying, why don't you share your tax returns, or he didn't have any tax liability, right? Because he understood the strategy, and it was actually being, the taxes were being offset by his real estate, all the income he was making from his businesses.
Yeah.
So it's all just about being educated, but you do have to be, bold enough to go against the grain and try these things, and I encourage investors to try it. I mean, you have to take action, right? If you don't take any action, then the knowledge isn't really that powerful. But once you take the action, you start to see how some of these things really work. That's a huge light bulb moment for a lot of people. Yonah, also, can you tell us about, so now, I think we're all excited that bonus depreciation is super great, but tell us what's happening with it lately, right? Because it is subject to phase out here over time. So can you give us that kind of time horizon and your thoughts on that?
Absolutely. So, as we mentioned, it was introduced in the 2017 Tax Cuts and Jobs Act. And when that was introduced, it had a timeline, meaning it had a sunset in 2023, actually coming up pretty soon. So 2022 is the last year that we can take advantage of the 100% bonus depreciation. And then it's going to start to phase out by 20% each year over the next 5 years. So 2023, if you buy a property, you want to use bonus depreciation, you can use what's called 80% bonus depreciation, meaning 80% of those accelerated deductions you can take in the first year, and then 20% you can still take on the faster cost segregation schedules, but you won't be able to take the 100% of that deduction in the first year. And then, like I said, phasing out by another 20% each year. Whether or not that's going to change, I mean, again, that's in the books as of now. We're in the summer of 2022, and that's what we have on the books now. Whether or not that will change, if there's some, in November 2022, there's going to be some elections, and there may be some changes. Who knows? I think this may be one of the things that is on the ballot. If it hasn't been talked about yet, it's definitely something that will come up.
Yeah, it will be interesting to see how that plays out, and which administration is in office to push which agenda, right?
Yeah, and you know what the amazing thing is, I mean, I've seen, and I'm sure you've seen as well, the real estate market has just gone crazy over the past 5 years. And I honestly believe this 100% bonus depreciation has been one of the main contributing factors to that, because you see tons of people investing simply for these tax benefits, and people buying properties. And I get people calling me up all the time from this time until the end of the year. I need to buy a property to get the bonus depreciation, before the end of the year. So they're just contributing, buying. I mean, the sheer volume of transactions that have happened in the past 5 years is just unbelievable. It just keeps getting more and more every year, even throughout the pandemic. There were a couple of months there in 2020 that people were kind of taking a backstage and just waiting to see what was going to happen. And then when everyone realized, well, we can still do deals, then went full force again. And 2020 was an incredible year.
Right. And I think there really is a need for it, right? Because we try to look at asset classes that are, very supportive of strong macroeconomics, right? Where there's a supply demand imbalance. And, I mean, even if you put all of the builders in the country to work, today, they still cannot keep up with the demand that's out there, right, in the next decade. So I definitely foresee this as, something that could continue in the foreseeable future. So we'll have to see on that.
100%.
One other key point here that investors may not be familiar with as well, but can you talk about the carry forward of the losses as well?
Absolutely. I mean, that's probably one of the biggest things, is that having this carry forward, which means is simply, if you have more deductions than you have income, then any of those losses will just carry forward, meaning you can use them next year or any future year after this. So you don't lose out. Some people think, well, what if I can't use those deductions? Do I lose out? And the answer is no. They will carry forward, and there's no deadline to that, meaning those losses will just be like on a line item on your tax return, like an imaginary bank account of those potential deductions. And then either until they're all used up or until you sell the property, that's when they'll be released, which is another amazing thing. We talked about the recapture tax. Well, if you have a big amount of these carry forward losses, upon the sale, those losses will offset the gain from that recapture tax. And so again, there's just another way to kind of balance that out and offset some of that. So that's a huge factor.
Right. So it becomes actually less important to do something like a 1031, right? If you have enough of these losses that you're accruing every year, you can be, it's just a rinse and repeat strategy. As long as you continue buying assets, you will get that, that loss, right? Every year.
Absolutely. Yeah, exactly.
Yeah.
And I think that's another thing you talked about Trump before. I think that was another huge thing. You just had like, billions of dollars of these carry forward losses that were just sitting on there. And some of them were not necessarily from rentals. Some of them could have been from, failed businesses and things like that, where any great entrepreneur has failed businesses, and
right.
those can accrue some losses that will actually benefit you from tax perspective.
Yeah, absolutely. Yonah, if you could just give one piece of advice to listeners about how they could accelerate their wealth journey, what would it be?
The biggest advice that I always give is just to continue education. There are so many little things like cost segregation out there that you'll never learn about if you just don't, look in to see what's out there. So listen to podcasts like this, and go to meetups, go to seminars, conferences, whatever you can do. There's so much information out there, whether you go to YouTube, it doesn't really matter. Just continue your education every day. Set aside some time to just learn something new and try to apply it as well. That's really the power of education, is when you can actually apply it.
Love it. That's excellent. Thanks so much for coming on the show today. Really enjoyed the conversation, Yonah. If folks want to reach out, learn more about cost segregation for their properties, or to connect with you, what's the best place?
You can always find me on LinkedIn. That's where I'm most active. Or you can go to yonahweiss.com.
Excellent. Thanks again for coming on the show, Yonah.
My pleasure, Dave. Thank you again for having me.